Welcome to a short video on accounting for income taxes. AASB 112 is the standard which covers accounting for income taxes. The accounting issue in relation to accounting for income taxes is that accounting profit, as determined using the accounting standards, is not the same as taxable income as determined using tax legislation. Accounting profit is based on accrual accounting, whereas taxable income is a mix of cash and accruals. This video will cover the two main practical considerations in the relation to accounting for income tax. The first is to calculate current tax payable, which is the amount of money the company owes the government. The second will be to calculate deferred taxes, both deferred tax assets and deferred tax liabilities, which in essence adjusts the tax expense as based on tax legislation and turns it into an accrual-based number. Turning now to the first part in accounting for income taxes, current tax. According to AASB 112, paragraph 5, current tax is the amount of income taxes payable or recoverable in respect of the taxable profit or tax loss for a period. This means to determine income tax payable, we need to know what the taxable profit or loss is. AASB 112 paragraph 5 helps out again in this respect and defines taxable profit or loss as a profit or loss for a period determined in accordance with the rules established by taxation authorities upon which income taxes are payable or recoverable. It is important to stress again that accounting profit and taxable profit are rarely, if ever, the same thing. Putting this as a formula, current tax is equal to taxable profit multiplied by the tax rate. So, if we had a taxable profit of $100,000 and a tax rate of 30%, the current tax expense and payable is equal to $30,000. This is the amount of money that the company owes the government in respect of the taxable profit that it made. However, at this point we have not discussed how the taxable profit amount of $100,000 is determined. Depending on the information provided, you may be given taxable profit. If that is the case, you don't need to do anything. If you aren't given taxable profit, you'll most likely have net profit before tax. If that is the case, then you'll need to adjust it to get taxable income. The adjustments to make are 1. Add back any accounting expenses. 2. Deduct any accounting revenues. 3. Add any taxable income. And 4. Deduct any allowable deductions. Whilst the above adjustments can be done for all profit or loss items, it's easiest just to identify those with differential accounting and tax impacts, like warranty expenses, long service leave expenses, and depreciation expenses. For example, let's start with $90,000 of net profit before tax. The only differential expense is a long service leave expense of $15,000. Long service leave is an accounting expense, but the deduction is only received when the long service leave is actually paid. As such, we add back the $15,000 and deduct zero. It's zero because no long service leave was paid this year, and the deduction is only received when the leave is paid. On the revenue side, there is interest received, which is in relation to interest earned in the previous accounting period. The revenue from an accounting perspective was included in the prior year profit and loss statement, even though it hadn't been received. However, from a tax perspective, interest is only included in taxable income when it is received. As such, we deduct the income revenue for this year, in this case $0 as we have no interest revenue, it was earned last year, and add in taxable income of $5,000 because the interest received is taxable. This leads to a taxable profit of $100,000. Once we have the current tax amount, we need to recognize it in the financial statements. According to paragraph 12, current tax for current and prior periods shall, to the extent unpaid, be recognized as a liability. In essence, this means we debit current tax expense $30,000, credit current tax payable $30,000. If the company hasn't paid any of the tax yet. If all of the tax is paid, then simply replace the tax payable with cash. Turning now to the second, and arguably more complex part of accounting for income tax, which is the determination of deferred tax assets and liabilities. Deferred tax assets are the amounts of income taxes recoverable in future periods in respect of A. Deductible temporary differences. There are a number of other things included in this definition, but for our purposes, A is what is relevant. Deferred tax liabilities are the amounts of income taxes payable in future periods in respect of taxable temporary differences. Before moving on to the calculations, it is important to note what DTAs and DTLs are not. A DTA is not money the government owes the company in the future, nor is a DTL money that the company owes the government and will pay in the future. Rather, it is the impact that recognized assets and liabilities have on future current tax payable. So, for example, long service leave is only a deduction when the company pays it. A $15,000 provision for long service leave indicates that the company expects to pay $15,000 in long service leave, which, when it happens, will lead to a deduction of $15,000 and less tax being paid. Therefore, a provision for long service leave on the balance sheet gives rise to a DTA. This will be discussed in more detail shortly. A couple of things need to be defined before we move on. The first are temporary differences. Temporary differences are the difference between the carrying value of the asset or liability and its tax base. The tax base of an asset or liability is the amount attributed to the asset or liability for tax purposes. How to determine the tax base is different for assets and liabilities. For assets, the tax base is the amount that will be deductible for tax purposes against any taxable economic benefits that will flow to an entity when it recovers the carrying amount of the asset. What this means is that if we have an asset whose benefits are taxable, we look to see how much of that asset is deductible. Take an item of property, plant, and equipment. Its benefits are taxable as we either use it to produce goods which will generate taxable profits, or we can sell it and get a gain which is taxable. As its benefits are taxable, we need to determine the amount of the asset that is deductible for tax purposes. For property, plant, and equipment, this is looking at its tax depreciation rate. In this example, the asset has been held for 1 year, had a cost of $1,000, and is depreciated for tax purposes over 5 years. This means that its carrying value for tax purposes, i.e. its tax base, is $800. As of the $1,000 in tax deduction it gets on this asset, it has already deducted $200 and has $800 remaining. If those economic benefits will not be taxable, the tax base of the asset is equal to its carrying value. For example, the economic benefit of an account receivable is the collection of cash. However, this benefit is not taxable because the company already included sales revenue in taxable profit, and as such, the tax base of accounts receivable is equal to its carrying value of $450. Turning now to the tax base of liabilities. The tax base of a liability is its carrying amount less any amount that will be deductible for tax purposes in respect of that liability in future periods. So, using the provision for long service leave example again, the deduction in relation to long service leave occurs when the leave is taken and paid. This means that the tax base of the provision for long service leave is the carrying amount of $15,000 less the $15,000 deductible in future periods, leaving a tax base of $0. In addition, in the case of revenue received in advance, the tax base is its carrying value less any amount of the revenue that will not be taxable in future periods. Now that we've discussed tax bases and how to calculate them, we need to discuss temporary differences, or more specifically, the two types of temporary differences. The first type are taxable temporary differences. These are temporary differences which result in an increase in tax payable in future years. They give rise to DTLs. The second type are deductible temporary differences, and these temporary differences result in a decrease in tax payable in future years. They give rise to DTAs. For taxable temporary differences, let's use the property, plant, and equipment example from earlier. Assuming a $900 carrying value and an $800 tax base, we end up with a $100 temporary difference. This is a taxable temporary difference, as this difference will lead to a higher tax payable in the future than if the company was using accounting depreciation. If the company was using accounting depreciation, it would have had $900 worth of future deductions, not $800. To get the DTL, simply multiply the temporary difference by the tax rate, which gives us a DTL of $30. For deductible temporary differences, let's take the provision for long service leave example. Taking a $15,000 carrying value and a zero tax base, we end up with a $15,000 temporary difference. This is a deductible temporary difference, as this difference will lead to a lower tax payable in the future. To get the DTA, simply multiply the temporary difference by the tax rate, which gives us a DTA of $4,500. Paragraph 71 allows for the offsetting of DTAs and DTLs in certain circumstances. So if the company is allowed to offset, the entry would be debit DTA 4,400, credit tax expense 4,400. Note that this is a negative expense, and this is pretty rare. Usually you would see DTLs being larger than DTAs, so you'd end up with a debit tax expense, credit DTL. Also note, the implicit assumption is that DTA and DTL opening balances were zero. If DTA was not zero, you would only debit it by the amount required to get to the closing balance of 4,400. If the company was not allowed to offset the DTA and DTL, then the entry would be debit DTA 4,500, credit DTL 100, credit tax expense 4,400. In conclusion, AASB 112 adjusts the more cash-based tax expense to an accrual system. To do so, you will need to A. Determine taxable income by adjusting net profit before tax. B. Multiply taxable income by the tax rate to get to current tax payable. C. Determine tax bases of the assets and liabilities. D. Calculate the amount and type of the temporary difference. And lastly, E. Determine the DTA or DTL and entries required. There was a lot of work in there, and I hope that helps. If you do have any comments, questions, or feedback, you can either leave them here on this video or tweet me at Dr. Dave Bond.